America's trade deficit has become a major talking point in U.S. politics, with both Democrats and Republicans expressing concerns about its implications. They see it as both a reflection of the country's ongoing deindustrialization and a contributing factor to America's growing economic dependence on China. Despite efforts by both the Trump and Biden administrations to address this issue, recent data suggests that the situation is worsening rather than improving. According to Commerce Department data released last week, the U.S. goods trade deficit surged to a record-breaking $153 billion in January alone. This spike was largely driven by businesses and consumers rushing to import products ahead of the implementation of Trump's tariffs. Given the continued expansion of the trade deficit, it is important to delve deeper into what a trade deficit actually is, what causes it, and why the tariffs imposed by Trump are unlikely to resolve the issue effectively. Before examining the broader economic implications, it is crucial to distinguish between bilateral trade deficits and overall trade deficits, as politicians often conflate the two. A bilateral trade deficit refers to the trade relationship between two specific countries. If country X has a trade deficit with country Y, it means that country X imports more goods from country Y than it exports to it. In contrast, an overall trade deficit considers the balance between all of a country's imports and all of its exports. When a nation runs an overall trade deficit, it indicates that it is importing more goods and services from abroad than it is exporting to the rest of the world. The United States, in particular, faces both types of trade deficits. It has an overall trade deficit and also maintains bilateral trade deficits with the majority of its trading partners. Although former President Trump primarily focused on bilateral trade deficits, there is a broad consensus among economists that overall trade deficits are far more significant. The main reason for this is that the intricate nature of modern global supply chains makes bilateral trade deficit figures somewhat misleading. For instance, while the U.S. runs bilateral trade deficits with most countries, it actually enjoys a trade surplus with the Netherlands. However, this surplus does not necessarily indicate that Dutch consumers are purchasing large quantities of American goods. Instead, much of America's exports to Europe pass through Dutch ports before being distributed to other European nations. Similarly, the reported decline in the U.S.-China trade deficit does not necessarily mean that Chinese producers are selling fewer goods to the United States. In many cases, Chinese exporters have simply rerouted their goods through third-party countries such as Vietnam, which reduces the recorded U.S.-China trade deficit but simultaneously increases the U.S.-Vietnam trade deficit. One fundamental aspect of trade deficits that is often overlooked is how they are financed. When a country runs an overall trade deficit, it must find a way to pay for the excess imports it is purchasing. In the U.S., this is primarily achieved through strong global demand for American financial assets, such as U.S. government bonds and stocks. Because the U.S. dollar serves as the world's reserve currency, foreign investors frequently exchange their domestic currencies for U.S. dollars in order to purchase these assets. This process, in turn, drives up the value of the dollar, making American imports cheaper and more attractive, while simultaneously making U.S. exports more expensive for foreign consumers. As a result, American products become less competitive in global markets, further exacerbating the trade deficit. Many policymakers, including Trump, view the trade deficit as a sign of declining industrial competitiveness in the U.S. economy. Trump's primary strategy for addressing the trade deficit has been the use of tariffs. The logic behind tariffs is relatively simple. By making imported goods more expensive, tariffs can encourage American consumers to buy domestically produced alternatives, thereby reducing imports. Additionally, by shielding American industries from international competition, tariffs can potentially support domestic production, increasing the volume of American exports. In theory, a reduction in imports coupled with an increase in exports should help narrow the overall trade deficit. However, there are several reasons to doubt that Trump's specific approach to tariffs will effectively reduce the U.S. trade deficit in any meaningful way. One major flaw in his strategy is that his tariffs are primarily bilateral, targeting specific countries such as China, Canada, and Mexico. While these tariffs may make imports from those particular countries more expensive, they do not prevent American consumers from sourcing similar products from other nations. As long as foreign investors continue to inject capital into the U.S. economy, American consumers will still have the means to purchase imports, just from different suppliers. Another contradiction in Trump's approach is that while he wants to reduce the trade deficit, he also encourages America's trading partners, such as Taiwan and Saudi Arabia, to invest in the U.S. economy. At first glance, this might seem beneficial, but as mentioned earlier, increased foreign investment in U.S. assets strengthens the dollar, which ultimately helps sustain the trade deficit rather than eliminate it. Additionally, countries affected by Trump's tariffs may simply redirect their exports through third-party nations to circumvent the new trade barriers. This has already been observed with China, which has routed exports to the U.S. through countries such as Vietnam to avoid direct tariffs. Beyond these specific issues, tariffs tend to have broader macroeconomic effects that can counteract their intended purpose. For instance, tariffs generally put upward pressure on inflation, which in turn can prompt the Federal Reserve to raise interest rates. Higher interest rates make U.S. financial assets more attractive to foreign investors, leading to even more capital inflows and further strengthening the dollar. A stronger dollar makes American exports more expensive internationally, reducing their competitiveness and worsening the trade deficit overall. Another reason why tariffs often fail to shrink the trade deficit is that the U.S. economy is significantly less reliant on international trade compared to many other countries. This means that when the U.S. imposes tariffs, the economic damage is often more severe for the targeted country than for the U.S. itself. The economic strain on the affected country can push down the value of its currency, which, by comparison, strengthens the dollar even further. Given that the dollar's value is determined in relation to other global currencies, this appreciation further amplifies the trade imbalance. Although Trump's tariffs have had mixed results, some argue that his broader objective is not simply to reduce the deficit, but to pressure America's major trading partners into agreeing to a restructuring of global trade rules, similar to what happened with the Plaza Accord in 1985. Under President Reagan, the U.S., along with the UK, France, West Germany, and Japan, negotiated the Plaza Accord, which temporarily reduced the U.S. trade deficit by compelling these countries to stimulate domestic demand, thereby increasing their imports from the U.S. There has been speculation that Trump's ultimate goal is to broker a similar agreement, which some have referred to as the Mar-a-Lago Accord, named after his Florida resort. However, replicating the Plaza Accord in today's geopolitical landscape would be extremely challenging. Unlike in the 1980s, when America's primary trading partners were also its key allies, today's biggest trading partner is China, a geopolitical rival rather than an ally. It is highly unlikely that the Chinese Communist Party would agree to such an arrangement. Even among America's traditional allies, cooperation on such a deal would be difficult given the current state of diplomatic relations. Furthermore, the Plaza Accord itself remains controversial, particularly in Japan, where many analysts argue that it contributed to the massive asset bubble that burst in the early 1990s, leading to decades of economic stagnation. Given this history, it is doubtful that countries would be eager to enter into a similar agreement today. Ultimately, while the U.S. trade deficit is undoubtedly a pressing issue, Trump's current strategies are unlikely to resolve it. Unless there is a significant shift in policy, such as a universal tariff applied to all imports rather than just targeted bilateral tariffs, the deficit is likely to persist. Even then, addressing the structural causes of the trade deficit, such as the strong global demand for U.S. financial assets and the dollar's role as the world's reserve currency, would require a more comprehensive economic approach.